The best thing an investor can do is to buy and hold over the long term. But in reality, this is easier said than done. Because I always have people coming up to me and say,
"The market is crashing now, Kelvin. How can you keep telling people to keep buying? We should be selling everything now and buy back when the crash is over."
That's why in this video, we'll be looking at studies and past data to help us determine how we should be investing during market crashes. Not only that, I will also share a few simple but important things that you can do so that if and when the crash comes, you'll be able to take full advantage of it and come out ahead of everyone else. But before I start, do join my 10,000 members Telegram chat group to discuss or ask any questions that you may have. The biggest reason why someone will panic sell whenever there's a crash is because he or she does not understand what they are buying. Imagine this. If you own a house that costs $1 million and one day some dude comes up to you and say,
"Hey, boy, you want to sell this house for $500,000 or not? Fast deal."
Obviously, you will say no, right? Because you know that this house is worth more than $1 million and you know it's dumb to sell it anywhere below that price. While this example seems funny enough, the fact is this is exactly what happens all the time in the stock market, where the market be like, "Sell the stock to me now at 20% discount," and you'll be like, "Oh, okay, can."
And it's gone. Poof.
So always make sure you understand what you are investing in. While there are many criteria as to what defines a good company, the three main ones are: can the company consistently increase their earnings? Does the company have low debt? And more importantly, does the company have a strong moat? There are many tools that you can use to do your research, such as the company tab in most brokers' apps, Seeking Alpha, FinViz, and many more. I won't go into details in this video, otherwise this video will be too long. But do comment down below and let me know if you want me to share how you can do company research. Otherwise, if you are too lazy or have no time to do research, the best alternative is to just go for broad-based market index funds, where instead of buying one company, you buy all the company. You won't buy the wrong company if you buy everything. For example, if you want to invest in the US companies, you can buy the S&P 500 ETF. Or if you want to invest in US growth companies, you can invest in SCSG. Or if you just want to diversify globally, you can invest in VWRA. The second reason as to why an investor would sell first and buy back later is because they think they can time the market, like fuck all. And I can certainly see the appeal of doing that. Because who wouldn't want to sell the stock at the peak, wait for a 50% crash, and buy back at the bottom? But there's just one tiny problem, and that is nobody can time the market. And when I say nobody, I don't mean I'm a nobody, therefore I can time the market. When I say nobody, it means absolutely nobody. For example, Peter Lynch, whose Magellan fund far outperformed the S&P 500, also saw huge crashes in his portfolio during his time. Same for Warren Buffett, whose portfolio constantly experienced drawdowns, especially in 2000 and 2008, where his portfolio dropped by more than 45%. So, does this make them bad investors? Of course not. There's a saying, volatility is the price of admission. If you want to get good returns, you have to be comfortable with seeing your portfolio going down 20, 30 or even 50% during market crashes, because that is the price that all investors have to pay when investing. For example, even when the S&P 500 ended the year positive, it still saw huge market drawdowns, like in 1987, 1998, 2023 and 2019. To add on, you will typically see a decline of 5% or more about 3 times in a year, or a decline of about 10% or more once every year. So volatility is very common whenever you invest in the stock market, which again brings us back to the question, if volatility is so common, why not just sell high, buy low? Check out this study done by Charles Schwab. What they found was that when you have perfect timing, you will get the highest return. Obviously, right? But since no one can time the market perfectly, it's more likely that you will end up with timing the market wrongly, which if that happens, you will underperform someone who's either just doing the dollar cost averaging or lump sum investing. Here's another famous example. By just missing the 10 best days out of the past 20 years, your return would drop by more than half. Miss the 30 best days, you might as well don't invest already, because you would barely get any returns. And if you miss the best 40 days, you will start losing money. And what makes timing the market so hard is the fact that the best days in the market usually happen right within 2 weeks after the worst days in the market. If you are looking for one of the most affordable trading platforms in Singapore, you can check out Webull. For the US market, during regular and extended hours, they are just charging a low fee of 0.025% with a minimum of 50 cents USD. And for overnight hours, they are charging 0.03% of the total trade amount with a minimum of 89 cents USD. Then for the SGX market, commission is 0.025% of total trade amount with a minimum of SGD 80 cents, and the platform fees is 0.025% of the total trade amount with a minimum of SGD 80 cents. Or if you are a new user, you will also get to enjoy commission-free trades for US stock trading for 1 month and commission-free trades for SG stock trading for 3 years. Also, if you are an US options trader, you'll be glad to know that Webull is just charging 55 cents per contract with no minimum fees. Plus, right now, both new and existing users will also get to enjoy US options free commission whenever you trade a minimum of 100 options contracts monthly. For new users who use my exclusive link to sign up to Webull, if you fund your account, trade, and fulfill the respective criteria, you'll be eligible to get up to $400 cash vouchers. Plus, you can get up to 7% per annum yield for USD Money Bull when you fund a cap of $100,000 for up to 90 days, where you can potentially earn a yield of up to $1,750. Otherwise, if you are an existing user who has not transferred any shares into Webull before, you can take part in the Transfer In promo, where you can get anywhere between $50 to $1,500 trading vouchers when you fulfill the requirements. So if you are interested, do sign up to Webull using my link down below. And let's get back to the video. But guess what? Even when there's a huge crash, the market has historically came back stronger and better. That's why the longer you can stay invested for, the better. For example, if you only stay invested for just 1 year, you will only be in the green 75% of the time. Stay invested for 5 years, your odds of making money becomes 87%. And if you stay invested for 15 years, there's almost a 100% chance that you'll be in the green. Historically speaking, of course. So don't try to time the market. Just consistently dollar cost average no matter what. Market up, you buy. Market down, you cry a bit, then you buy more. In fact, you don't even need to do this yourself. Most brokers let you set up recurring investments where you can invest anywhere from every working day all the way to every month. So just use that. Now, with that being said, I'm sure some of you will still be like left ear in, right ear out, and will still try to time the market. So if you still insist on doing that, here are a few ways as to how you can improve your market timing. 1. Buy near support and resistance levels. If you don't know how to look for that, here's how. First, open up TradingView, click on Indicators, search for support and resistance levels with breaks, and boom, you will see all the potential price levels that you can place your trades. For example, if you had placed a buy trade at the $199 and $196 resistance levels, you would have bought Apple right at the bottom of the recent crash before it jumped back up. But of course, you don't all in at one price lah. It's better to split your buy trades to several levels. Like, you can set a buy order at $199, $189, $182, and so on. Then, you slowly buy in as the stock drops. Then, there are also dynamic support and resistance levels. For this, you can click on Indicators again, then search for the simple moving averages, 50, 100, and 200. Then, you can see that these 3 lines can also act as supports and resistances. So, you can also place your buy trades at these levels accordingly. Now, besides looking at technical indicators for good entry points, one other way is to also look at the intrinsic value of the company. In case you do not know, intrinsic value just means what's the company's fair value after we have calculated all the future cash flows of the company discounted back to the present value. Now, in order to get the best results, you will need to do your own research to be able to come up with an estimate for the company's future growth rate. The more accurate your guess, the more correct your intrinsic value will be. Otherwise, if you want an easy way around this, you can also check out projections by other analysts. For example, if you go to Guru Focus, then under DCF, you will see the fair value of the company, which in this case, it says that Apple has a fair value of $174. Another website is FinChat. Under modeling, you will see all their calculations, and at the bottom, you will see the implied share price of the company. So what you can do is set buy orders at around these price levels and wait for Apple to fall there. Last but not least, here's one more bonus tip. If you have enough capital to buy 100 shares rather than buying the shares outright, what you can do is sell puts at the price that you want to buy the stock at. This lets you earn additional income while you are waiting to buy your stock. For example, let's say you want to buy Apple around the $196 resistance level. Then what you can do is sell a $195 put that has around 45 days to expiry, and in return, you earn $110. If Apple falls to that price, great! You managed to buy the stock at the price that you are comfortable with while getting paid $110. And if Apple doesn't fall to that price, it's great too. You will still get to keep that $110 Chai Fan money. This strategy is especially good during this period where the volatility is high. Since the higher the volatility, the higher the premium. For more info on how you can sell and manage your puts, you can check out this video here. Anyway, that's all for this video. Hopefully, you found this useful. Like, share and subscribe as I'll be posting new videos every Monday, Wednesday and Friday.